Welcome to After Hours at Traders Post for Friday, November 7th, 2025. I'm one of your hosts, Tom Hartman, marketing manager here at Traders Post, joined by Peter, Exit Liquidity Hartman, to break down the market madness. After Hours is your go-to live stream focused on macro trends for retail traders. That's dollars, equities, and policy for the uninitiated. After Hours is brought to you today by Blue Sky, the best-in-class prop firm that offers same-day activation, daily payouts, and no max restrictions. But we'll tell you more about them later. For now, we turn to markets. Peter, have we bottomed? That's the big question. Have we bottomed? To me, what we've been seeing since October 10th is basically America bungee jumping. And we don't know how long that cord is, and we don't know how close that ground is. And hey, we all want that cord to pull before we hit the ground. And maybe today was that day.
You think?
What do you think? I do.
I don't know. I mean, today in the meeting, in our all hands meeting with Traders Post, John was asking you this exact question, like, hey, Tom, I thought the markets have bottomed. And you seem to think that, yeah.
Look, the reason we had these issues with the markets are threefold. The tariff uncertainty, right? So we saw these tariff issues back in April. I'm just going to pull up the chart over here. We saw this back in April. And then we saw it again in recently. So we had a 26% drawdown last time. That was a crazy drop. And then it reversed back up. And then we had sort of a smidgen over here. We had over here was the tariff issue from Donald Trump, and where he tweeted out, I think, we'll put 500% tariffs on China. Markets didn't like that. Markets fell. Not nearly as much as before, but it did. And we had a whole bunch of volatility afterwards. Then once that got resolved, we had a rise up. But then we had the effects of the tariffs are still there. People had rejiggered their supply chains a little bit, canceled some orders, started other things, relocated at different locations. And, there's some money that was on the table that was spent that didn't need to be spent, and some issues there, right? So on the economy side, there's some softening that happened there. Then what did we have here on October 29th? Jerome Powell comes out, and in his Q&A, he's asked about the market's pricing in a Fed rate cut of 25 basis points for December. And he says, hey, it's not a foregone conclusion that there will be a cut in December. It's not a foregone conclusion, which was news to markets, because in December, he was basically saying, hey, we cut 25 basis points. And when they asked him, hey, do you think what's 25 basis points going to do? Shouldn't you be doing 50? That's what Stephen Miran, the new member of the FOMC board, was saying, the Trump appointee. Well, not appointee, but he worked for the Trump administration, and he's there in order to push things towards cutting. And he's like, well, we don't have to do that because of forward guidance. The markets are already priced in rate cuts into the future. So it's like we cut more now. That's basically what they're saying. It's like we cut more now. So that people heard that to mean, okay, then we're going to have rate cuts all the way down the line. And no, that's not the case. So we're seeing here, at the same time as a drop in the Nasdaq, we had in the dollar. You guys remember over here, the dollar bottomed in the September FOMC meeting, and then also started rising again after the October one over here, right? So the two last Fed meetings has caused the dollar to rise. What does a rising dollar mean? Financial conditions are tightening as far as liquidity is concerned. People are buying more dollars, they can buy something else. When people are buying something else, they have to sell dollars in order to do it. The dollar's going up. So it's been in this uptrend essentially since the end of September. And that's worrisome. Now, the dollar did rise back up to the top of the range that it's been in since April of this year. So remember, April is where we had the whole tariff issue. So that's where the dollar's been going sideways. Not sure what's going to happen. So now that we're at the top of the range for the dollar, the expectation now should be, look, there might be a little bit more upside, but if we've bottomed, that this is the top for the dollar and we are going to be headed lower. And if we're headed lower, risk assets should rise up, and Bitcoin should rise too. But we are in a bullish trend for the dollar. So that is worrisome, but it's pullback. Now, as far as equities are concerned, as far as equities are concerned, and crypto to me is part of the whole equity package. That's I always think of it that way. We do have, I mean, it was pretty rough week. So we had the dollar that's been in a downtrend since essentially the beginning of October, and in fact, we've been in a sideways channel for months now. Basically, since this is May of this year till now, we've basically been in a sideways channel. It's not a 30% drawdown, right? That's not what we're seeing. It's not a 30% drawdown, which is totally normal even for a bull market for Bitcoin. Drops 30% all the time. So we're not there. And we're certainly not at the 50%, which is what we see at the beginning of a bear market. But we did see liquidations and issues and bankruptcies within the space, very reminiscent to FTX, Celsius, 3AC Capital that we saw last time. But because people aren't as exposed as they were back then, we didn't have that same problem now. So this is actually fairly bullish. So you'll see on my chart over here, this is one of the indicators we've talked about on plenty of different platforms here on Traders Post, this idea of this yearly moving average for Bitcoin. We're now very near that level. So that to me means that we're ready for a bounce. This is like the last leg I was looking for that. If you take a look at this on the daily, you'll see here that often when we get down to that level, when we get to that red level, we bounce, we bounce. So this is the last sort of thing I was expecting. Could we go down to 95, 93, 94, 92? We'll see about that. But I think we're nearing a bottom, that we basically have a bottom now for Bitcoin. At the same time, when we take a look at equities, we switch back to the Nasdaq, we'll see here that we also cleared a bunch of outstanding levels. So for example, there were gaps in the price in the opening, and well, let me put this on the regular hour so you can see. So Peter, do you see these gaps here?
Yeah.
So often gaps will fill, but the price will come back, revisit the gaps in order to fill them up. And so we were wondering this whole ride up. I mean, it was day after day after day after day after all-time high, all-time high, all-time high. And we're like, are we ever going to revisit those gaps? And it turns out, yeah, we revisited those gaps. And now that we've cleared them all, the next gaps, and we just cleared one of the gaps today on the upside, we do have one more gap here at in November, that was created November 4th. And so we could ride all the way back up to all-time highs. So we're seeing a bottom signal in Bitcoin. We're seeing a bottom signal in equities. I would not be surprised if we had more upside to come. Also, so we had the issues with the tariffs. We had the Fed forecasting that maybe the rate cut in December is not going to go. But then we also had tightness within the funding markets. Right? We talked about this last week and the week before. Funding markets for repo markets allows the Fed to offer overnight funding to institutions so that they can either borrow or lend money at a guaranteed interest rate. And this allows the Fed to control short-term interest rates. And what we saw was a huge spike. There were spikes in the repo facility. So let's see that over here. We had these big spikes in the repo facility, which were reminiscent to what we saw in 2019 during Volmageddon, right before the Powell pivot, where there just wasn't enough liquidity and the Fed had to provide funding to financial institutions for them to be able to continue going. Because you can imagine if they're not doing that, they're going to have to sell assets. And so they need to provide this funding. Over the last few days,
why is it bad? Why is it bad if they sell assets? Why is it bad if people are forced to sell assets? Isn't that better for the market than artificially doing something?
Oh, naive summer child. No. If you sell the assets, then if some people sell the assets, then other people will also start to sell, because the selling will cause the price to come down. And they're like, well, the price is coming down, and it'll come down to a level that to someone else is their price to sell. And then they'll sell, the price will come down, and the other person is their price to sell. Then you have the market makers and the dealers who they are selling options on the other side. So they are, in order to be delta neutral, they are participating in the market, not to move the market up or down specifically, but to be neutral. So when they're selling, that's happening, they also need to sell in order to balance off their books, because they're taking the other side of the bet, ensuring the people against the sell-off. So they, if they have to pay out, they have to be balanced on the other side. And so it can exacerbate the selling. So this is called a negative gamma, and it can spiral out of control. We want the positive gamma when prices go up. Oh my God, it just keeps going up because they have to buy, they have to buy, they have to buy. Everyone likes that if you're on the long side. But on the downside, it can get hairy pretty quickly. So no, the markets don't want that. And it causes uncertainty, right? And you need this recalibration before things get back into state. It could be weeks for the market to get back to state, and then you don't know what other leg of the house of cards of debt in the global financial system gets Nancy Kerrigan before things get back under control.
Nancy Kerrigan, okay, deep cut. I wonder how many people under 35 know that. All right.
So I thought it was interesting here. So we had that was from Nick Timmerose on X, who was sharing that the rates right now for SOFR have fallen back down into normal ranges, so that the stress is now gone. So had the resolution for the China tariffs, and the only thing that's left is the rate cuts. Are the rate cuts going to happen in December? And we had Stephen Miran come out recently on the Jack Farley podcast to say something to that effect. Let me just go ahead and play that. I want to know all about Stephen Miran. There's a whole podcast that Jack Farley did, an hour's worth on YouTube. You guys want to go check that out? I'm going to listen to that this weekend. Yes, that'll be what I do on my weekend. Sit with a nice cup of chamomile tea. I don't like when tea has too much caffeine inside of it. It can make my head all loopy. So I just like the warm water and my tisane. And I'm going to listen to Stephen Miran on the Jack Farley podcast here talk about federal open market committee drama. Ooh-wee. So we have here just a small clip from here from that show. 1 second.
I expect us to cut in December unless there's some sort of surprise. And I guess the reason I would say is as follows. When the chairman speaks, he's representing, to an extent, the range of views around the table. And there absolutely was a wide range of views around the table. But when you look at the distribution of votes around the table, it's different than the distribution of views. And so for that reason, I would expect, based on current information, that we end up cutting in December, but nothing is absolutely guaranteed. At the end of the day, always the scope for new information. But at the moment, my expectation would be that we end up cutting. I think it's the right choice. I think it's the right policy decision. And so I think that we'll end up doing the right thing.
So I love that. I love when, Peter, I love Fed speak so much, because it's like being in a relationship. You got to read between the lines, and you have to figure out what the person actually wants, and some things they have to provide without actually asking it. It's a whole dance here. And what the Fed absolutely wants is to lower volatility, keep prices low, and fund the debt. But they don't say that. That's what they want. And so, but then there's politics within the whole thing. Like, who wants to steer the ship of this thing? And so Stephen Miran, in this short clip, says there's a diverse range of views, right? But don't be distracted by the diverse range of views and the dissents and all that happened in the minutes, because when that actual voting came, there wasn't a huge amount of dissent. He's saying here on one breath, hey, we need to cut. We definitely need to cut. Don't worry about the Fed cuts not happening in December. I think we're going to do it. Why? Because it will be the right thing to do. Ooh, I love when the Fed officials start saying phrases like it's the right thing to do, because normally they come out with some PhD stuff.
Right.
Our PCE core inflation metrics are in relationship to the CPI year over year. We're showing a spread here that is disconcerting, and so we need to do this, that, or the other. When they cut, just go on, it just feels right to cut. They're cutting. They gotta be cutting. We're gonna be cutting those rates.
So you think? So you think they will cut?
Well, On the SOFR markets, the futures markets, we have, where is it here? The odds of a cut. So this happened at the Fed meeting. Oops, sorry, I'm on the wrong tab. At the Fed meeting on October, where he said that the Fed rates and the cuts in December are not guaranteed, we went from a 90% probability of a cut to a 62% probability of a cut. Since then, we've moved up, and then I like looking at the poly market for this. Poly market says that we have a 71% chance of a cut, of a 25 basis point cut. So it's rising up. Here's the thing. Why would Powell say we might not cut in December? Like, why would he do that? Is it because he's like, well, I don't want Donald Trump and the Trump administration to bully us into doing what they want us to do? That in order to save the independence of the Fed, it is worth it to not cut, have the economy suffer, just to show that we can't be pushed around?
That's what I was saying. And you were saying that why would the Fed chair go against the president's wishes? This is what I keep talking about, that there's a political battle going on. Maybe it's not political. Well, I guess it's political in nature. And that, and you said, no, they're going to do what's responsible.
Well, if they don't cut, everyone is going to know that it's because of this aspect. Like if it was hidden, if it was like, me and a couple other people who are talking about it, I'd be like, okay, maybe they don't do that. But everyone's going to know that they're not cutting because they don't want to appear beholden to the Trump administration.
So it's damned if you do, damned if you don't.
No, I think then they can't. I think what they do is say they might not, in order to be like, oh, they might not do it. The market moves accordingly. Look, the Fed can control the weather. And then when they do cut, they'll be like, okay, we changed our minds. But we might not have.
Okay, so it's just like when I'm driving and my partner's like, hey, why don't you just take a look at the map? And then I'm like, I don't need that map. And then a few minutes later, I'm like, what does that map say again? Like, it's kind of like that. And I know I'm using a reference from 1990s stand-up comedy, but a map is this piece of paper, kids. We used to unfold these maps and look. So, okay, I get it. So you're saying that they are political. They don't want to seem like they're being bullied. And this is their strategy to have their cake and eat it too.
That's right. So I think policy-wise, we don't have to worry about that so much. And if that's the case, if all those headwinds now turn into tailwinds because they get resolved, well, then we recover, right? We pull back from the lows, and I wouldn't be surprised to see. I wouldn't be surprised to see next week. Let's say we get a resolution to the shutdown. That's the other thing, the shutdown of the government. Let's say that gets resolved. We're going to see all-time highs, I think, that day. So as we anticipate that's going to happen, this is why I was saying, I said before, I think we bought them previously. It was because I never expected that the shutdown would just keep on going.
Right. You said that in the meeting today. That how long has the shutdown been going on for? Hang on, let me go and check. And,
quite a while.
This is the longest shutdown, right?
This is the longest shutdown in history. Yeah.
I mean, the pain that people must be feeling right now, it's going to be.
Yeah, absolutely.
Is the shutdown?
So I think that
36 days.
Right.
Starting on
and
October
counting.
1st.
Like they're not making it seem like they're not going to like they're not really talking about undoing the shutdown anytime soon. They seem like they don't want to cave at all. So I'm not sure what to think here. But I think
wait, hang on. If the shutdown, I'm sorry, what you were going to say, I cut you off.
Oh, that's fine. Go ahead.
If the shutdown continues, are we just going to be like in this place until we recover, or can there be some serious repercussions?
I don't think so. Because what happens is that as the shutdown is happening, the Treasury General Account is building capital, right? All the tax receipts and the are going into the Treasury, and then all the bill issuances, that money goes into the Treasury, and then they're not spending it. And so I think now it's over $1 trillion in the Treasury. So the more it increases, it's like the Powerball lottery. People are going to be like, one, we're getting every day that they have not undone the shutdown. We get closer to the shutdown being resolved,
Right.
and the longer it takes, the more money that's going to come and flood back into the system. So you
Is
sort
this
of
not
like
going to affect the credit rating at all?
it might, but the United States has all the guns, so what are we worried about here? Credit rating?
Okay. Okay, so interesting. So once the shutdown resolves, then the money starts being allocated. Then everything, the gears start working, and everything just kind of picks up steam very fast.
Yeah, that would be my expectation, but you don't have to take my word for it. We can just listen here to Tom Lee from Fundstrat, who lays out the scenario pretty clearly. Let's just go ahead and we won't listen to the whole thing, but just a couple of minutes of it.
All right. Well, check out Bitcoin because that's rallying more than 3% after dipping below $100,000 yesterday for the first time since June. So what does today's bounce back mean for crypto and for the broader market? Joining us now is Tom Lee, Fundstrat Head of Research and CIO and a CNBC contributor. And Tom, it's great to have you back on.
Great to see you. So
let's start right there because we did have a bit of a bounce back here in Bitcoin and really across the crypto landscape today. But yesterday, as Katie Stockton over at Fairlead pointed out, Bitcoin broke below its 200-day moving average. I know she's watching some technicals there pretty closely. How about you?
Yeah, I mean, I think it makes sense to watch the technicals for Bitcoin. As you know, Bitcoin is very sensitive to market liquidity and also perceptions about risk appetite and risk premia. And, over the past couple of weeks, I think there have been headwinds building, right? From the government shutdown to a hawkish Fed cut that was done last month and uncertainty about December. And as you know, with the shutdown, Treasury liquidity, the Treasury General Account's actually been building cash. So I think all of these created a cascade of problems that put pressure on crypto. But hopefully, as you know, headwinds become tailwinds when you can resolve these things.
Yeah, I want to hone in for a second because I'm not sure we've been talking enough about it, but that funding stress we've seen in SOFR, I know there was data that was put out on Monday showing just a huge drop in that secured overnight financing rate on Halloween from the day before. Should we be paying closer attention to that and what that's meant in terms of the liquidity picture across asset classes?
People definitely pay attention, Morgan, because one, as you know, that can often be an early sign of stress, but it also takes place when there's window dressing. So and banks are doing window dressing at the end of month. So I am kind of watching it, but I think those funding stresses have eased. And of course, it hasn't spilled over and reflected in what should be building stress in either credit markets or in bank equities. And so I would just say that it's an anomaly and it may be due to the shutdown, but yeah, it's worth watching.
Okay.
You're muted. You are muted.
Yeah, so that's totally worth watching. You guys want to go take a look at the CNBC clip for that in order to hear the rest of it. And he goes on to explain, like what we were talking about before, the one of the themes within Wall Street is this idea like, hey, these stresses that we're having right now are temporary. They're not event-based. It's not some global catastrophe. It's not a global pandemic. It's not. It's just technical because of the shutdown and the dynamic between the Fed and the Trump administration not wanting to ease rates right away. Before we continue, I actually do want to go on. I want to hear the bull case here, which comes from Darius Dale. I'm looking forward to watching that. There is a bull case here of, hey, if we have bottom, like what do we do here in order to capitalize on it? Like what are the trades? What should we do in order to? Is it possible to double our money from here? The answer may surprise you, but yes, it's totally possible. But we'll find out more after a word from our sponsors.
Looking for a prop firm that actually plays nice with automation? Meet Blue Sky, built for serious traders. And with Traders Post, it just clicks. You connect Blue Sky inside Traders Post, route your TradingView signals to paper or funded accounts, and let it auto-manage entries, stops, and targets. You control risk per trade, filter by session and symbol, and pause or resume with a single switch. Every fill is easy to review in one dashboard. Funded accounts can request payouts daily with launch plans starting at $49. Get funded with Blue Sky. Execute with Traders Post. Apply today at bluesky.pro, BLUSKY.pro, and plug in your edge. Trading involves risk. Use proper risk management.
So before we get to Darius Dale's fantastic take on the bullishness for the markets, this is Darius Dale from 42 Macro. I want to take a quick detour to Cathie Wood, who said something very surprising on CNBC the other day. Let's take a quick listen.
Stablecoins are usurping part of the role that we thought Bitcoin would play. So our bullish forecast out there is 1.5 million by 2030. Given what's happening to stablecoins, which are serving emerging markets in a way that we thought Bitcoin would, I think we could take maybe $300,000 off of that bullish case just for stablecoins. So watch that space. Stablecoins are scaling here, I think, much faster than anyone would have expected. Stablecoins are usurping.
Very surprised to hear that.
Wow.
Right? This is a far cry from the Saylorism of $100 billion per token for Bitcoin by next week. I kid. Sailor and I, we have this back and forth love-hate relationship. Don't worry about it. But this is the first time I've heard someone roll back their prediction for how high Bitcoin can get, and she's out to 2030, right? You could have imagined that she could just let that sleeping dog lie all the way to 2029. She didn't, which leads me to believe, and she's not the only one doing this. There's other places who have increased their forecasts, and other locations have decreased their forecasts. And you're like, okay, people are seeing the stability, the slowdown in Bitcoin, and the volatility of Bitcoin, and the performance of Bitcoin. And they're going, look, we've had all-time highs again and again in futures markets, but we're not getting that in Bitcoin. Why on earth are we doing this? We have all the headwinds. Donald Trump is buying Bitcoin, his first burger with a Bitcoin the other day. The Bitcoin Strategic Reserve, the Clarity Act, the whole thing. Everyone's screaming from the top of their lungs, Bitcoin needs to be in everything. BlackRock's talking about it, Larry Fink. Bitcoin everywhere. Bitcoin's has not gone up. And now you have Cathie Woods coming out here going, hey, we're going to cut our forecast down, which means, and she said just for stable coins, which means there might be other factors in which they would lower the projection for Bitcoin. So I thought that was fairly interesting.
Didn't we talk about the possibility there might be shenanigans happening to keep the price of Bitcoin down?
Yes, what's happening, I don't actually have the link here right now, but actually, let me see if I could pull it up, because most of the funding pressure that we're seeing, the selling pressure, sorry, not the funding pressure, the selling pressure that we're seeing on Bitcoin is coming from Binance. Here it is. So if we take a look at Binance, we're seeing that nearly all of this is a post from TraderView2 on X, who says that nearly all of the active sell pressure on BTC spot markets has come from Binance over the last 2 days. All of the markets are basically flat. So this is a cumulative volume data that's trying to measure the direction of when the volume comes in. Is it a buy or sell? And we're seeing that most of that selling pressure is happening on Binance. I mean, this is suspicious. What is happening here? And he goes on to mention here this, if you take a look, that was on spot Bitcoin. If you take a look even on perpetual contracts, the futures for Bitcoin, for Bitcoin, you're seeing, again, still it's Binance that's more. Yeah, we're seeing some correlation with the futures market on other exchanges, but not nearly as much as we're seeing on Binance. Peter, I haven't really talked about it much because there's all kinds of shenanigans going on over there. This thing with Wintermute, there's liquidations that are happening, and that people are not necessarily sure what's going on. Some people have really hot takes about the conspiracy that's going on, where they're causing the price of Bitcoin to fall deliberately in order to allow billionaires and some of these other players to come in, that it's like a service being offered at Binance to lower the price of Bitcoin so that you can get in at a lower price before it takes off. But then you have stuff like there's an interview with Peter Thiel. You're getting all my information. You're getting all the sweet details here, folks. Peter Thiel came out the other day, was talking about how he sold basically most of his Bitcoin. He's sort of like out. That it's been co-opted by the elites, and that it's no longer fulfilling the promise of what Bitcoin needed to be. And then you see long-term holders Sorry, those Cardano, yeah. Then you're seeing the long-term holders selling, and then you're not seeing the retail participation. And you're seeing massive amount of shorts, and you're like, "What's happening? What's going on here in the Bitcoin space?" So, I don't have any insight into that, but it looks like there is some sort of manipulation happening within markets, which I think is a silly term, but them's the breaks. All right, I wanted to end off here on this clip from Darius Dale, who was on the close the other day, talking about the bull case. He is one of the most articulate members of FinTwit that I've seen yet, talking about the bull case for markets. And you don't want to fade Darius Dale. He is a quant. He is a data analyst of high degree, high intelligence, high caliber. And so I've been listening to him for many, many, many years, and he is just really on the ball when it comes to growth, inflation, policy, that sort of thing. So just hear his take here on the bull case. Not hearing it?
Oh, not hearing it.
Here we go.
The S&P rebounded today as AMD reported better than expected earnings in its latest quarterly results. Other companies in the AI sector also boosted the markets after valuation concerns just yesterday. Let's go to Darius Dale. He's co-founder, and CEO of 42 Macro. Thanks for joining us today. What factors do you consider when looking at economic growth in the U.S.? Because I know that's one of the things you're taking a look at.
Yeah, that's a great question. So obviously we remain in this government shutdown here. So we have to rely a lot more on leading survey data and data from alternative sources. And by and large, they're confirming the resiliency of the economy, which is a theme we've maintained for over 3 years now. We got the ISM services report this morning, and it was very much in support of an economy that is poised to rebound, particularly when you look at the spread between the backlog and new orders. And so it's our view that we remain on this sort of train track towards a much more expansionary economic environment over the next couple of years.
So the ISM, if you remember, is the survey that's done with manufacturers in order to see, hey, is there a expectation? It's a survey. So is there an expectation of growth in the future versus contraction? And we've been sort of middling for a while now on the ISM, and he's saying that started to pick up a bit. And so since we were at the low of the cycle recently, the idea is that we have way more runway ahead of us as the expectations go up and away. So he's saying, well, if that's there, then that's a feather in the cap for the people who are bullish.
You mentioned that you're looking at other sources of information with the government shutdown. Is the government shutdown a drag on the economy?
Oh yeah, of course it's a drag. I mean, but how big of a drag? Is it going to cause a recession? And the answer is small and no. And so in that context, I think we need to move on as investors and focus our attention, our focus budget, if you will, on things that are more impactful for asset markets.
Okay.
In our opinion, we think that. Oh, go ahead.
No, I'm just.
So he's saying no here, small and no. I love how he talks. He goes small and no, because he's saying, look, this could be a dip. It could be a dip because of it, but it might cause signals to appear recessionary, but it's not a recession. Darius says a lot, and so I'll be the Darius whisperer and just translate some of the stuff for you guys.
Wondering, you've got a massive government. You've got a massive population. How could a government shutdown that goes so long not really have a massive effect on the way things are run in the country?
Well, if you just think about the categories of spending that are actually impacted by the government shutdown, it's actually not a tremendously large amount. Obviously, if people stop showing up for work at the airports and whatnot, that's where the real shutdown impact is likely to that's what we're likely to see in the economy. But I would turn our attention away from the shutdown because I think it's an overcovered news story to an undercovered news story, which in our view we continue to anticipate. At least our models continue to anticipate structural regime change at the Fed. We think that's the number one story that folks are not paying attention to right now, and markets will be paying attention to in the next 3 to 6 months.
Okay.
All right. So structural policy at the Fed, the way that the Fed is structured and what they're targeting. Okay, so when you're dealing with cyclical, you're dealing with growth, inflation, unemployment, and inflation numbers and prices. When you're dealing structurally, you're dealing with the flow of liquidity through the system. So you're saying that if there's a shift at the Fed from dealing with growth and inflation in order to adjust policy, and instead it's liquidity characteristics of the market that modify policy, well, that means they can issue liquidity, issue money, regardless of what happens on the inflation and growth front. So he's saying this is one of the major things that's not actually being paid attention to when it comes to the current macro dynamics. People are focused on growth and inflation, and they're not seeing that regardless of that, they might actually have to focus on providing liquidity in the markets to prevent utter collapse. And this might be a regime change for the next 5-10 years. And how would that change your portfolio allocation?
Can you explain a little bit more what you're seeing?
Yeah, so our research continues to indicate a Federal Reserve that is K-shaped monetary policy. It's creating all sorts of adverse distribution outcomes, negative outcomes.
All right, so K-shaped economy, adverse distribution outcomes is that the rich get richer and the poor get poorer. The divide between the rich and the poor keeps increasing. And so those who are exposed to assets and asset prices go up, either maintain or increase their purchasing power, whereas those who are not exposed to the markets are losing purchasing power, right? Through assets being priced out from the range or from the growth not being there and jobs not being there and all that sort of thing. So the 90% of the spending, 70 to 90% of the spending, consumer spending within the United States comes from the top 10%. So as long as the top 10% still have funds, still have money, then the Fed goes, well, there's no problem with spending. Sure, there's some problem at the low end, but we're going to adjust that over time, blah, 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 blah. So he's saying that the Fed's policy is K-shaped. They need to keep things afloat, so they have to cater to those who have, and there's not much they can do or are doing to those who are at the low end of the income scale. And that bifurcation is increasing, causing the middle class to either fall to one side or the other, and that Elysium basically by the end of it.
For the consumers and the households on the bottom of the K. And as a function of that, we're seeing an increased amount of pressure from thoughtful investors and economists and obviously the administration circling the institution, and they'll eventually sort of land their punch in terms of trying to get this institution to realize the negative impact that it's having in terms of perpetuating the K-shaped economy. And so ultimately, we're going to see, in our view, until we get something that pushes us off this theme, we think we're going to see a much lower term structure of interest rates next year. And we may even see some creative balance sheet policies to address these K-shaped outcomes that we continue to see in American society.
All right. Well, I'm not going to play the whole thing because it's definitely worth a watch. Go to the Darius Dale YouTube. So it's Darius Dale 42 on X, and he's also on YouTube as well. You can go check out his clips and his minutes. Definitely worth a follow. The guy is a wealth of information, and of course, I used to subscribe to his service before. I do less macro things. I do more prop firm things now, so I don't bother as much. But absolutely worthwhile.
I need a
Peter.
Darius translator for regular people because
he's actually much better now than he used to be. But because now that he does this full time, he's the founder of 42 Macro. But it's funny. He's very erudite, and sometimes I think when he's talking down, it still sounds leagues over.
Yeah, I know it really does. Like if a doctor was talking to me about that, like giving me my diagnosis that way, we're gonna have to do some mitigation strategies and correct for this. I can't even think of the words. No, we got to cut off your leg because you have cancer. Like that's how you have to put it. Listening to what he said, it sounded like there was a lot of he was describing something radical. Like a radical change in the behavior of fiscal and monetary policy.
Yeah, because as the liquidity conditions become, first, the more K-shaped the economy becomes, the more the populist movement will increase. The more those who are at the bottom, which is most of the people, 90% of the people, they're going to be like, this is not acceptable. And they will demand policies from the government in order to rectify it. Well, in order to rectify it, the government's going to have to find what he said, creative ways of funding this. If that's
Yeah.
different term structures for how to finance the government through bill issuances, if that's different ways of having money funnel through the system in order to get money in the hands of regular people, just so they don't riot.
UBI,
Sorry?
universal basic income.
Maybe that, probably not, because that's, talking about a surplus that that can be distributed. This is different. This is debt monetization. This is
Right.
other programs in order to find money where there's no money. So it's money printing essentially. And so he's talking about they're going to have to find ways of doing it. And so if they're going to be switching to the structural point of view, well, what happens if the government starts putting money in the hands of people at the bottom of the K-shape economy? Well, we're going to get
going to
sort of
end
like
up
what we
right
had.
back during COVID.
Right. Exactly. What did we see during COVID? We saw meme coins, NFTs, markets at all-time high, GameStop, AMC. These are all effects of what happens when regular people like you and I get our hands on that sweet, sweet dinero. We put it right back in the markets because we want to have a little bit piece of that pie. Plus, they're talking about it. They're going to be lowering the requirement. You're not going to need $25,000 anymore in order to trade futures. They lower that to $2,000. They're tokenizing everything. Even private equity, and markets are going to be open 24/7 by the time Robinhood gets their way with it. They want people money into the markets. Why? Because this train ain't going to stop. That's the Lynn Alden line. Nothing stops this train. Markets go up and to the right, and if you don't like it, see rule number 1: markets go up and to the right. So he's saying they're going to have to do this, and if they do this, what do you think happens to markets? And he goes on in the clip to talk about it, but go give him a like and a follow on that. It's totally worth it.
I think Sam Altman saves us. Although, have you been seeing the robotics that's being shared on X from Tesla, from Unitree?
Yeah.
Like, the robots are coming. And, I see these demos about them doing laundry and stuff. I don't need a robot to do laundry. I'm not going to buy a $30,000 robot to do laundry.
Yes, I'll buy a $30,000 robot to do laundry. Thank you.
Well, what I mean is, it's in manufacturing, it's in the warehouses, it's delivery, it's that sector of the economy that's going to be affected more immediately. I think there's already robots working in factories, like actually humanoid robots working in factories. So that's going to
Amazon
escalate.
says they want to automate or roboticize 75% of the workforce in the next couple of years. I think Amazon's the largest employer in the world, right?
Or close to, yeah. It's nuts. So I do see radical things coming. And part of why I mentioned UBI is because I think this is what, I think Andrew Yang, running for president, he talked about this, where we need to take the profits from these AI companies, and I'm throwing in robotics companies there now because there's also AI, in order to take some of that revenue in order to redistribute it, because those job losses, you can't just have millions of people without work or reduce work.
There's no way that's going to happen. There's no chance they're ever going to do that. It's I don't believe it. It doesn't make any sense. They could do it now, right? The surplus, anyways.
No, but AI companies are not making money right now. They're losing money hand over fist. But when
I'm saying the government.
Oh, yeah. Okay.
If they're not, let's not get into the politics of it.
Okay.
I just care about the trades. And we're not going to be sitting here hoping that what they're going to do is give money to people just like George Bush did, just like Donald Trump did, just like Biden did. They're going to put money in the hands of people, and that we can bank on. And when that happens, I hope you got your Pepe coins and Bitcoin. All right? I hope you got your meme stocks. I hope you got your stuff, because it'll go up and to the right. Tom, why do you think it should go to the right? Because it's not going anywhere but that. Let's hear what was the comment?
Adventure Trader says, I need a robot for laundry and dishes. I also need one to watch these romantic comedies with my lady so I can watch the charts. Be careful what you wish for. Some of these robots, I don't know.
You're going to be on Reddit eventually going, robot took my wife. Oh.
I hear what you're saying. I don't, it sounds crazy to me, but we're living in a world where I am seeing crazy things on a regular basis, things that I never thought possible, and they haven't been implemented into society, and I don't know how that's going to change things. For example, you have Tesla coming out, they're coming out with their AI 5 chip that's going to be radically better than their previous chip, and it's tailor-made for Tesla, but it's going to increase their ability or make their ability to use AI technology far more efficient. How is that going to affect self-driving cars? How is that going to affect the Tesla robot? Elon was talking about
Using all the
taking
cars for
SpaceX public.
influencers.
Was that?
Oh, right. Well, he was talking about making all the cars that are not being used for inference for AI.
There's that too. So there's these effects, these dominoes that are falling, and I don't know that we've seen it affect the economy yet. I'm very curious as to what that's going to be, but I think it's going to change things radically.
That's why I don't take trades on those things. Peter, my life has a series of losses, massive losses, when I have let a narrative take play.
Right.
The Treasury General Account has more $1 trillion and more in growing of funds. The Fed has a mandate in order to lower prices and keep unemployment low. And then there are the market force dynamics of people who are forced buyers and forced sellers. That's it. If that ever changes and I see that happen in price, then I'll change my mind. Until then, I don't care. Donald Trump was out there the other day in South Korea going, and threw off, he goes, I don't understand. We have to do something about the economy, about the stock market, because every time I do good things, the stock market falls. And every time I do bad things, the stock market goes up.
Yeah.
He goes, we got to fix this.
Yeah, that's right.
The president thinks this is a problem. It ain't changing. All right. Well, that's it for us today on After Hours here at Traders Post. We'll be back next Friday at 4 p.m. Eastern Standard Time with even more market commentary, news, and tidbits. If there's anything else, any stories you think that we should cover that we haven't seen, please let us know in the comments. And of course, be sure to like and subscribe. Once again, the show is brought to you by Traders Post. We're here to create a platform that allows you to not only automate your trades, but also implement advanced trade execution. That's right. Peter calls it the Iron Man suit of trading, and that's exactly what Traders Post is. So you can feel free to go to traderspost.io and get your 7-day free trial today. Peter, anything you want to say before we leave?
The show's also brought to us. Oh, am I muted? No. Show's also brought to us by Blue Sky. They're fantastic. Adventure Trader says, thanks, guys. Thank you, Adventure Trader. And it's almost 5 o'clock, so you're almost free to get back to the charts. What do you trade crypto? You got to get onto those charts.
Are closed. Oh no,
Build
crypto.
your
That's
bot.
right. I can trade crypto.
Trade crypto. Build your bot. Adventurer and I, we spend our free time doing, I guess, similar things. We're just like working on AI and doing chart things. But yeah, that's what I got to say. Thank you to everybody for watching. Really appreciate it.
And as always, we wish you happy trading.